Welcome to the podcast and live on video. It's a Vox Screens Stocks, a weekly edition here with John and myself. We go through stocks via a screener. They're filtered in some way. John, what's this week's filter?
Income and growth. So, we are in an environment where growth is going to be hard to come by, and a lot of returns will be driven by dividends in the sort of years ahead. We might be in for a very muted period of price performance.
Yeah.
So I want dividends. And
that's, do you know what? I've been buying stocks for the last, probably starting in September really, and I break my portfolio down into size of companies and risk basically, and the top two sections are sort of big caps, mid caps, and I'm looking for dividends as well as good growth and all that stuff, because in fact one of them I bought is money supermarkets. I think people will be checking prices more, and even though the energy section of their business is non-existent pretty much, they're still doing well, they're still growing very well, and then the dividend is like 3-4%. And I thought we're going to have, I find this hard. I think we're going to have a trading range for a while. I think we're going to go up and down. I think we pretty much hit the bottom of the market. I don't think we're going to revisit October lows. I doubt it, but I who knows? But if that's the case, valuations are going to get very stretched with any sort of rally we see, and it'll come back down to a range, maybe not the low again. But while that's happening, if you're accumulating stock via dividends or reinvestment of dividends, I think that's an easy way to pile up some a good bit of a holding in good companies and get paid dividend. Get paid for waiting, and so I see that as a way. So I've got some decent dividend payers in my portfolio now. So I got Money Supermarket, Pets at Home. I think a couple of Jupiter Fund Management is one, and Ashmore Group as well. And what else is there? Oh, MJ Gleason as well. So in fact, that's a smaller cap. But yeah, but if I'm going for like I said, companies have good sort of or good businesses or will be good businesses. If I'm going to sit around and wait, I want to be paid for that essentially.
Well, especially if you wait, over time.
Yeah.
And this obviously doesn't happen overnight, but if you reinvest those dividends over time, the compounding effect is quite significant.
Yeah.
It's a massive proportion of returns, stock market returns over the years.
Yeah, do you know what? It's a classic chart, I think. I think it was from the Telegraph or somewhere. I used to use it a lot, and saying the difference between reinvesting and not, and it's phenomenal over time, like you say. And these the business I'm investing here, like MG Gleason at the moment, is hit a low, went back up, and it's come back down a bit. But I still see, okay, they're not going to sort of blow the doors off anyway soon, but they're cutting costs. They're going to cover the dividend quite comfortably. They're always going to sell houses. It's fine. They're not going to outperform 2021 because of course it's a bit of a downturn. But they're like off 50% off their highs last year, and I think I don't mind if they go down a little, because I'll keep sort of earning some interest off that way, dividends off that, and I'll accumulate. It's fine. I'm not overexposed to them. I've got a position I'm comfortable with. But I think will housing return? Yeah, it may take a couple of years, but we are a nation of wannabe house owners, and it's always a good industry. And like I said, the margins are good in that business. Everything's quite good, so I'm happy to hold. And likewise with other companies as well. It's sort of dividends. So this is it's an interesting filter here.
Yeah, so the other thing I'm looking for, I think you alluded to there, was that a company can continue to pay its dividends. So
yeah,
a company that pays dividends is a company that's generally in pretty decent financial health. It's generating enough cash, surplus cash, that it can return it to shareholders. But some companies, because dividends in this country are sacrosanct, they don't want to cut that dividend. So some companies may stretch themselves to keep paying the dividend, even though they probably shouldn't be. So we are looking for good dividend cover as well, which you mentioned. We want to make sure that companies can pay that dividend.
Yeah, and in fact, talking about one of the house builders, was it Persimmon who cut their dividend was up so high. I mean, people sort of, that's the thing, isn't it? People, when you're looking for dividends, don't look for the highest dividend because yields, because it's not sustainable. And generally, because the share price has fallen so much, they can't afford to keep it. And the share price may have fallen because, they're not doing so well. They can't afford to cover that, so they may cut. So so range wise, dividend cover is very important, isn't it? But I mean,
it is, and I've actually put a cap on the yield the absolute level of yield we're looking for of 10, which I still think is pushing it a little bit. I think sort of 7, 8, you're starting to ask questions about the sustainability of that dividend. But I'll put a cap on at 10. As it happens, nothing has popped out in the screen that's above 6.5. So
you may get the odds. You may get the odd lucky sort of payment of dividends, but I said sometimes they'll be cut, and sometimes they'll take the share price down, won't it? Sometimes, so be careful of that. I look generally. I try to look at about 3 to 5% on that, because anywhere over that, like you said, you start to see that needle hitting the red lights where you think this is not sustainable. But okay. So
I mean, the other thing I've talked about dividends a lot. The reason this screen adds growth in as well is it's part of that sustainability. So I want to see a company that's expected to grow its earnings. I haven't put a cash conversion element in this, which I probably should. Maybe one for next time. But if a company's growing its earnings, then I'm confident that it might be able to keep paying its dividend as well. So not one without the other.
Let's get straight into it. I saw the list, and you said to me on a Slack channel, they said, no guesses for the one I'm going for. Now, I know, I think I know, you've not told me, I've not told you what I'm going for, but I think I know what you're going for.
Go on, then.
You've been quite bearish for a while, but the stocks you've tended to like will do quite well in a bearish environment. In an economic downturn, I think they'll benefit from that. And so I'm saying you're going with, you're putting the hat on. Basically, H&T.
100%.
Right? So explain what H&T do.
It's a pawnbroker, to all intents and purposes. I actually bought some on the back of their latest results. I haven't bought a lot for a while, but I bought these. You can argue it's counter-cyclical, basically. And I know the economic data is sort of mixed. There are signs, strong jobs market, but we've avoided recession narrowly, as we heard at the last budget. But I do think there is a lot of pressure on the consumer still, a lot of pressure in the economy, and pawnbrokers do well when times are tough. And so basically what it does, people go in with we all know how a pawnbroker works. You go in with your watch, and they take it off you in exchange for some money. Obviously, a lot less than the face value of that watch, and hopefully you pay that money back and you get your watch back. But it doesn't always happen.
Yeah, I've never been in a situation where I've had to do that. So,
no, me neither.
So let's say I got a watch that's worth say £1,000. Like, I'm stuck for cash, but I haven't got one of those anyway. But let's say I'm going there, and so how does it work? So they give me what, 800 quid, 700 quid?
Yeah, 600 quid. Yeah.
Okay.
And you go, you have a term, and at the end of that term, you take that, you pay that back, and you get your watch back, or you lose the watch. So the other thing they do, as you would expect a pawnbroker to do, is they have these pledges. That's a pledge book of often jewelry, or watches. Watches is in fact the fastest growing area of their business. Which doesn't surprise me. I wrote something maybe a year or so ago about watches of Switzerland.
Yeah, they were doing very well, weren't they? People splashing out on watches. When the times are good, people splashing out on watches. Then all of a sudden they think, I need to sell something. Yeah.
And it's the watch. It's the watch that goes. So they've actually seen watches being traded in for higher value loans than they would generally offer. Most loans are about 200 quid. But people are coming in with watches and taking bigger loans, which for me is a sign that all is not well in the world necessarily.
Yeah.
So the other thing they then do is they have this big pool of stuff, which they then sell. So they essentially run a jeweler's business.
But they charge you for a fee. For example, let's say you got a pledge. I don't know. They say you can buy this back for this amount within like a month or whatever. If not, then they realise that watch is worth £1,000. In fact, who's buying those watches? I suppose they can get bargains there.
Well, this is
buying them.
This is the thing. There is a thriving second-hand market for this stuff. So the pledge book that they have is growing. It's over 100 million now. Lending volumes are at record levels. But equally, they have a retail business selling this stuff that comes in. They take it to a processing centre. Obviously, scrap stuff that's more scrappy. They'll scrap. Or they'll restore stuff and sell it. But the retail business is doing really, really well.
Okay, so when they give you, say, 600 quid for this watch, that's a loan that they charge you on, is it?
It's a loan, basically.
Okay.
Yeah.
All right.
Yeah. And your collateral is the jewelry, the watch, whatever it might be.
I see.
Yeah.
Wow, it's a little bit depressing when it's doing
It
very
is a
well,
little
isn't
bit.
it? I know.
Well,
But
I mean, you
but
say
they do
that.
gold as well, and so they
Yeah.
do gold, and and gold prices at the moment is doing well because well, who knows, and Bitcoin is doing well. So yeah.
Yeah. But I mean, gold is, a safe haven in tough times, and these are tough markets. But it is fundamentally a depressing concept. A pawnbroking business, but they've been around for a long time. Actually, arguably they're actually doing some good because, if you think back a few years, you had the payday loans industry. Your Wongas and whatnot, which caused all sorts of, public outcry about these things. I think the Church of England was invested in Wonga, strangely enough.
Right, yeah, I know.
So, not great. However, short term, essentially unsecured, but short term credit is, a lot of people really need it, and especially now that the cost of living crisis has really bitten hard. You take away those payday loans, where do people go for short-term credit? And the answer is, generally speaking, worse than an H&T or even a Wonga. It's the local loan shark. And so at least here you have some kind of regulated business that is providing what is arguably an essential service to a proportion of the country that are facing tough times. So depressing, but also in a sense providing something that people need.
Yeah, well, I did look at recently on a webinar with the membership club. There, looked at their results. What is it? The 31st December, aren't they? And just looking at the growth here, just growth wise, top line 43%, operating profit growth 126%, net profit growth 147%. And so operating cash flow growth went down, but and free cash flow went down, but value wise, what P 13. Price to book 1.1, EV operating profit 9, EV EBITDA 6 and a bit. So good value, good growth. Like I said, and they got what's the dividend? Is about 3.5, isn't it? 3.5.
Well, so forecast yield is 4.8%.
Wow. Okay.
And a forecast PE is 7.9%. Sorry, 7.9, not percent. This is a value share, and a value share that to me looks very, very well positioned for what I think is going to be a bumpy few years economically.
Yeah, so I did look at the chart, and they did do well, didn't they? Come off recently on the chart, so
yeah, a little bit,
and I mean, it rose to those results, I suppose, isn't it? And it's come off a little bit, but it's fine. It's just it's a good uptrend. Listen, it's from literally January 2022. It's been a trend from 288 up to £5 pretty much in December 2022. Look at that in that year. So already you see signs there. When the market was tanking, this, like you said, this is counter-cyclical, but it's rolled over now. But it seems to have a little bit of support from the 200-day moving average, which is, like I said, around about what are we at the moment? Yeah, around about say 420, 430 is a good support there. But so to me, you've just got a bit of it seems a bit of consolidation, bit of profit taking, but it's supported by, like I said, good valuations and a nice dividend. So I like this. And are they very breezy about an economic downturn?
I think they play everything with a straight bat, which I suppose is the only way to be. Another company we've talked about before is Begbie's Trainer, which I would also say is counter-cyclical. These companies have struggled to make headway. I think the market wants good news, good times. But as you know, I'm a realist. I wouldn't say a pessimist, but a realist.
So, you know what we should do? We should do a screener on depressing, bearish, or almost like bearish, happy bearish stocks, which are like happy and bearish times. It's like pessimistic optimism. But I mean, in fact, looking at the outlook statement, say looking to the future, they say there we remain confident that the trading environment will be positive for our business, basically, but not for everyone else.
No.
So in particular, we are. I suppose it doesn't have to go inside. I mean, I suppose it's going to boost on their own.
There is another string to this company's bow, which I should mention, really, which is not as depressing as pawnbroking, which is foreign exchange, travel money, basically. So they're doing really well there as well, because people are going on holiday again. So it's a sort of it's a strange old thing, It's a sort of combination of bearish economic sentiment and the rebirth of the travel industry. But that's why I think when I wrote this up recently, I think it's basically got it's sort of positioned that it can cope with ups and downs, and I think that's a good thing.
Well, do you know what? The traveling, there were record figures. In fact, that's why I invested in on the beach about 4 months back. I think 2-3 months back, because I just saw they raised a lot of money, and their share price due to COVID had been slashed, and they got no debt. I think they raised about 65 million. There was 65 million cash there, and their growth was doing very well. Their margins were very good because it's just basically a portal, and I quite like portals because you get the Auto Traders or the Right Moves or whatever, because they got good margins, and like I said, they own no inventory on the beach, and they've been advertising a lot. So I think they're capitalizing. So I'm hoping to see an uptick in that because, people, I think just because of COVID last couple of years, and the prices did go berserk. When there was an interim period of where people could go on holidays, the prices went mad. But now they've come back to a bit more normal levels, and people are booking. Like I said, lots of holiday makers were reporting record numbers in January. And so, I quite like that. But H&T is the ticker. And like I said, we should do this, counter-cyclical screeners. Maybe we should do that. And of course, Begbie's and H&T will be in that. I don't know how you screen for that, though. Is there a way of doing that?
No, I will do my best.
Maybe
I'll find a way.
Maybe you should get a manual for 5 stocks, maybe, and manually add them, put them in a sort of manual screen, so not too many stocks, but things that could do well in a downturn or prolonged downturn. Because I don't see that Jeremy Hunt, when he said that about a recession, I think technically he was talking about, did he say this year we're not going to be a recession? But I think what that fails to point out is there'll be very little growth. We may not contract for 2 consecutive quarters, but we may dip in and out, So
bouncing along the bottom. I mean, there is one other company here that I like. We spoke about it before, which is Severfield, which is an infrastructure play.
Yeah,
and one thing I do think is going to happen, regardless of the economy, or even perhaps because of a period of economic weakness, is that governments will be spending a lot of money on large civil infrastructure projects.
Yeah. So, but the thing is, we had inflation figures in the UK today, which weren't very good. And part of me thought, was that a typo by the ONS? Because it was expected to come in at 9.9, down from 10.1, and it came in at 10.4. That maybe it's through 9.4. Does anyone check that? I thought the ONS are figures people; they should know about that. But I think the most important thing is really, because I've seen some of my stocks rally, which retail stocks, oddly, but I think the big figure will be, of course, later on today, which is the Fed going. In my mind, I'd be surprised if they do 50 basis points, because there's a lot of fires they're putting out at the moment, which are largely down to what they've done, raising interest rates very quickly. So I think they can't just stop and say, okay, we'll stop, but they could slow it down a little bit, because they do, they are having to put out fires everywhere, and I think they don't want to sort of start stoking those up and create more fires. So part of me thinks it'd be sensible to do 0.25%. How the market takes that, I don't know. But what's your thoughts? Any thoughts on that?
I think 2.25. I think it's 25 basis points today. I mean, you say they don't, they've created the fires by raising rates. Arguably, a bank like SVB, its difficulties were of its own making. And the inflation is massively problematic. It's particularly problematic at a sort of lower end of society, where the rising cost of food, which we know is behind the surprise jump in inflation in the latest figures, that affects the poor in society much worse. So inflation is a massive problem. Not just for the markets, but for society as a whole. It's hugely destabilizing, and central banks cannot take their foot off the gas. The problem is what they don't know is if they pull that interest rate lever, is it actually going to work?
But also but also they're looking at lagging indicators.
Exactly.
Where I think inflation is sort of slowing down. So I mean, like I said, interesting figures. What was the PPI? index there today actually went down. Last month it was 0.4%, expect to come in at 0.2% today, came in minus 0.1, and that's that feeds into. So while retailers are still lifting their prices and stuff, the input costs into that are going down, so that will reflect slowly. And I just don't know how well, we know they've broken a little thing, and I think the problem in America as well, of course, is the sort of local banks and all that. Is this correct? I mean, your deposits are guaranteed up to a certain amount in these regional banks, but in the bigger banks, the entire amount is insured or something like that. So they need to sort that in some way.
I saw that interview with Janet Yellen.
Yeah.
I presume you saw the same thing, and that does seem to be what she was saying.
Yeah.
And if that's the case, then that in itself that's a massive policy error, because you'll just see those regional banks coming under huge
if you want
pressure.
a system, if you want a system where it supports regional banking, you've got to give them the same, sort of securities and protection as the big banks. Because over here, of course, in Europe, we have big banks basically, and not many regional ones, small ones, pretty much. But over there, they have this kind of system, and it seems like the regional banks, and everyone now is pulling their money at these regional banks, and that's where their share prices are dropping like crazy, and chucking them into JP Morgan and all that stuff. So
precisely, well, this has happened before. These things happen. These things happen, and they happen again. We had the secondary banking crisis when we lost a lot of the regional banks in the UK. The savings and loan crisis in America. Way before the financial crisis. And the big get bigger, and then if you've got a few large banks that essentially run then they do become too big to fail.
Or if they do fail, another big bank swallows them up, and then it becomes a little bigger. It's like it's nuts, isn't it?
I mean, indeed, the Credit Suisse UBS thing. I mean, it has echoes to me of HBOS, Lloyd's, ABN getting swallowed up by RBS.
It's almost like like eating a nice meal, but it not being cooked properly, and you get food poisoning. So something in there is good for you, some nutrition in there somewhere, and it's going to help you. But there's a bit of food poisoning in there as well.
It's not great,
and that can take you down for a couple of weeks, couple of months. So
not great at all. It's a tricky one. I read a really fascinating, just on the subject of inflation, and while these figures today might not have been expected. The piece I read, it was by the chief investment officer of an investment company called Ruffer, and they specialise in capital preservation. So what they do is basically they don't try and blow the lights out. They're not a Scottish mortgage. They're just trying to beat inflation, which all of the capital preservation trusts have really struggled to do this year, because of this sort of what I've heard called a correlation crisis. Everything was expensive, bonds, property. It's really hard to hang on to cash. And what this guy, the chief investment officer, has said is it's not headline inflation that we should be worried about. It's inflation volatility. So that actually inflation whipsaws around, and it makes it really hard to position yourself to deal with anything. So you might go, right, I want an inflation protected portfolio. All of a sudden inflation falls away, and you're in the wrong place.
You're performing, and
then inflation bounces back when you change your position again to something that is reflecting lower inflation. So inflation volatility is the big worry at the moment. Not inflation.
And that's why I think this screen you've done today is good, because you can see the screen, by the way, on the blog, all the companies listed in there. But I think that's why, because essentially you just take a longer term view of a good business paying out decent dividends that you can sustain, and you accumulate shares, reinvest them, and then all of a sudden when the market starts to rally, you've got a lot more shares and you make a lot more money. And of course those shares are free, pretty much, the dividend shares, aren't they? So
absolutely.
Cool stuff. Thanks for that, John. Speak next week.
Thanks, Jonathan. See you later.